that you hear today are simply the opinions of those present, and you should always obtain your own legal advice or property advice or finance advice. So perhaps I'll hand it over to Stevie for an intro and some housekeeping matters.
Thanks, Jeff. Yes. For those that don't know me, although I'm seeing lots of familiar faces, I'm Stevie J. Turner. I'm a senior financial advisor with Tribeca Financial. I've been an advisor in the industry since 2009 now. So although I have a bit of a baby face, I think I've got a few years underneath me now. And I do work with people from varying ages, from 23 to 83. I've got clients in that range. And anyone from a simple situation, sort of very basic, trying to simplify, to very complex, what we would call private wealth clients with multiple entities and lots of properties, financial trusts and self-managed super funds. So that's a bit of my experience and expertise. And the housekeeping today, please keep your cameras on. We like to see your beautiful faces. Pop yourself on mute unless you want to ask a question, but also we'll be monitoring the chat function in there that you can pop your questions in there. Thanks, Bea.
Thank you. I think now we'll move on to Frank Oliveri. Thank you.
Thank you, Vee. Thanks for the invitation this morning. I'm the National Director of Investment Services at Colliers, based in Sydney. I'm also the Managing Director of the Colliers Western Sydney offices in Liverpool and Parramatta. I've been involved in the commercial property market for about 25 years, both as an agent, but also in my own development and investment companies as well over those years. It's fair to say that we're probably in what I would say one of the strongest commercial markets I've experienced during my career. And it's been interesting that during the 4 months of the COVID impact here in Sydney, it's probably been even stronger than what it has been at other points over the last couple of years as well. And there's been pretty strong demand across the investment and development market, whether it's been the commercial office market with a number of the institutional investors looking to buy in that part of the market, but also in terms of some of the smaller assets for private investors and also self-managed super funds. And the childcare sector is one area that has probably seen substantial interest and substantial growth, and seeing yields sort of go to all-time sort of lows in terms of level of interest. But in saying that, the residential development market has been extraordinarily strong as well. I think similarly to Melbourne, large land subdivision has been in strong demand, sort of stretched both down to the south coast and also up to the north coast from Newcastle and beyond as well. But then the unit development market has been pretty strong as well in the inner city areas. And you've got changes in the market like rent, which has been very strong in Melbourne for a while and is becoming stronger in Sydney now as well. But given that interest rates are so low, a lot of people, rather than leaving their money in the bank where they're going to earn minimal interest or return, are happy just to put the money into opportunity. Thus the reason why sharper yields. But we're also seeing a lot of people putting money in land bank opportunities as well.
Yes.
In relation to putting money into 50, 100 or 1,000 acres around the place, with the view of taking a 10 or 20 year sort of wait and seeing that area sort of progress. But I did touch on, and if it's okay, Vee, I'll just sort of touch on childcare as key sectors. I did indicate it's probably been one of the stronger markets of late. And the simple fact is that childcare has always been deemed to be recession proof, but it's probably seen to be COVID proof today as well, given the level of government support to the childcare sector. But for an investor point of view, who are quite traditional, who may not understand commercial necessarily, have been very happy to invest in childcare because of obviously the strong fundamentals of it, mainly because you've got triple net leases where the tenant's taking a 10, 15, and in many cases 20-year leases. They're paying all of the outgoings, they're paying for the maintenance of the property, they're doing capital expenditure to the property as well. And pretty much an investor can put the asset in the bottom drawer and not have to worry about it for 20 years because they know that everything is being covered and paid for by the tenant during that period. And obviously, as I said, the government support is a key thing in relation to that. We are finding that social infrastructure seem to be the sort of flavour of the month. And where we were sort of seeing traditionally childcare investments at sort of 6.5%, 7% yields historically, I think the norm at the moment for an asset in childcare with a long-term lease that's circa 8 to 15 million is probably sort of 4.8%, 4.5% in some cases, up to about 5.5%, depending on the quality of tenant, whether it's a major or a private. But we are finding some of those smaller centres with long-term leases that are more achievable in that sort of $5 million mark or less, are probably even pushing it sub 4% in the current market. But then also equally from the other side of things, whether if it's a large childcare centre, and obviously childcare centres are getting even bigger these days, we're seeing some childcare centres selling for 15, 20 and even 25 million. And we are finding a lot of the institutional purchasers are buying those types of assets. And they equally can be sort of sub 5%, in many cases sub 4.5%. So I think childcare is probably the sector that is of most interest at the moment, and certainly has a spotlight on it. And I know there's been numerous articles, but as I said, residential development has been strong, but anything from an investment perspective has been strong as well. So happy to take some questions a little bit later on, Vee, but yes, it's an exciting time.
Thank you kindly, Frank. So we have, I think we do have a few questions for you, and also we do have some lenders who will attend to, lending in regards to childcare sector as well. So we now move on to Ron for a quick introduction. Ron, go ahead. Thank you.
Thanks, Vina. Thank you. And thanks, Frank. Actually, really interesting snapshot of the market there. So my name's Ron Cohen. I'm a property and business lawyer. I've been a partner at a city-based law firm, Tisha Liner FC Law, for many years. And my specialty in property is acting for vendors and purchasers, commercial, residential, industrial, off the plan. I do a lot of commercial and retail leasing, as well as commercial loans, acting for both lenders, borrowers and guarantors in preparing documents or reviewing and providing advice on loan structures, etc.
Thank you kindly, Ron. We may now move on to Jeff White, and Jeff White will touch base in regards to the property market. And maybe I'll shoot the first question. How Sydney and Melbourne values gone when you compare August data with September data?
Yeah, interesting. Looking back at the data over the course of the last couple of months, and this is residential data, so this is a bit of a snapshot on what's going on residential-wise. In answer to your question, we saw Sydney rise in August by 1.8% and September 1.9%. Melbourne, we saw rise in August by 1.2%, and still a rise, but a 0.8% in September. So it went from 1.2 to 0.8. Probably due to the severe lockdowns in Melbourne that impacted the property market, but that's probably the reasons. But just some high-level data there also, Vee, just for everybody's sake, all the capital cities in September saw a rise in their value, so positive across the board. The highest growth was seen in Hobart, where we saw a 0.3% growth in the values down there. The lowest was Darwin with 0.1%. But that every capital city saw growth in the residential market over September. Other observations, Vee, in Sydney, as I said, 1.9% in September. Brisbane and Adelaide rose by 1.8%, 1.9%, so very, very strong markets there. But some years ago, Brisbane and Adelaide were certainly not performing at the same rate of Sydney and Melbourne, but they've certainly come into their own in recent months. If we go back over 12 months, just for your information, we've seen capital growth in all of the cities better than 15% over the last 12 months. Melbourne was the lowest capital city with 15% growth. Again, probably very much due to the lockdowns that we've experienced and the impact on the market there. Hobart was the highest over the last 12 months, where it saw 32% growth. And as we all know, the auction markets are performing extremely well. We're seeing clearance rates, depending on the data companies that you follow, anything from the high, in particularly the Sydney and Melbourne markets, high 70s, even into the very early 90s, depending on 90% clearance rate. So all signs are positive there, V. And we mustn't forget that before, as COVID hit, we had analysts saying that the property market was going to drop by 20 or 30%. Some of them out there, we all recall those. Well, it's certainly done the opposite, and it's performing extremely well, and there's a lot of light at the end of the tunnel. Back to you, V.
Thank you kindly, Jeff, for the update. We may now move on to Ron. Ron, what are some of the main differences between buying residential and commercial property?
Yeah, that's a good question, really, the differences between both of them. Really, with residential, it's very much a single use. It's either owner-occupier or alternatively you're renting it out for occupation. Whereas with a commercial property, there's multiple uses. You know, you can have an office, you can have it as a restaurant. Frank was talking about childcare. So there are multiple uses with that. The other thing is, even in terms of leasing, the leasing landscape, there's different types of legislation. The residential tenancy legislation probably tends to be a little bit more favourable to tenants in terms of when you can evict a tenant. Things like normally they just pay rent, whereas the landlord has to pay outgoings. On a commercial, the leases are a little bit longer. There's also retail leasing legislation as well about things like minimum terms. So in Victoria, you've got the Retail Leases Act where a tenant is entitled to a minimum tenure of 5 years. Oftentimes it'll be a rent plus outgoings, although some outgoings like land tax are often excluded for retail tenancies. And the only other thing really is the GST issue, where with a second-hand residential, generally there's no GST applicable, whether that's on purchase, sale or rent, whereas on a commercial property, you do have to have GST considerations as well. So there's sort of a few little differences between one and the other.
Thank you kindly, Ron. Now, you know, the Property Cove is an interactive concept to bridge the gap and to bring industry experts together. So today we're very fortunate we do have few lenders on board. And I'd like to thank Andrew Bamford and Luke Sorrenti to be present today. And I'm going to ask the first question for the audience. Now, what are the changes in policies regarding commercial and business lending? So maybe I'll have Luke to give us a brief, please. Thank you.
Yeah, no worries. Thanks, Vee. Look, I'm only speaking to ANZ. Obviously, different lenders have different policies and, you know, different niches and appetites they'll do. But the way we look at our commercial property investment space is what some lenders will refer to as a lease stock product. We, you know, for the most part, ring fence the transaction around the lease that's in place on the commercial asset. We break our assets down into different categories. So you've got retail, office, and industrial. There are obviously special purpose assets, but limited appetite for those sorts of things. You know, like some of those property experts that we've been spoken about before, we did take a conservative approach during the 2020 year around the restrictions imposed by COVID and not knowing what the property market was going to do. And ANZ pulled back our maximum LVRs that we could extend on properties during that time. We have since relaxed those on certain assets. So to bring us back more in line with market, commercial, industrial or warehouse spaces, we're back up to 65% LVR as a maximum. However, we've still got a semi-conservative sort of approach on retail and office. You know, just given the market at the moment, we don't know what's going to sort of happen with retail and with office spaces. Obviously, a lot of businesses are supporting the working from home arrangements. So there is reluctance to return to the office. So we are extending those assets at a maximum of 55% LVR. So I guess from a recent change point of view, yeah, we've gone back to 65 on assets that have got strong history of people not exiting. Just to give everyone a bit of a breakdown of how we look at these transactions, we're not going into the nuts and bolts. We're not looking at people's living expenses and if they've got a credit card or whatever the case is. As I said, we ring fence the transaction to the lease that's in place, and we assess it on 4 bases. 1, the quality of the tenant. Obviously, if you've got a blue chip ASX listed company as a tenant or a government as a tenant, that's fantastic. So, we're assessing them to a degree. Obviously, we're not getting financials from them or anything like that, but we're just assessing their ability to be there long term. 2 is the LVR on the property, so loan to value ratio. The third one's the ICR, or interest cover ratio. So when we're looking at, servicing of these sorts of things, we're not looking at, how much income does it spit out? Can they pay their accountant? Can they pay their tax? All that sort of thing. We're just looking at, are they achieving a minimum interest cover ratio on the asset? Just to give you an idea, for a retail property, it's minimum 2.5 times interest cover ratio, or for an industrial property, it's 2 times. And then the fourth thing would be the WALT, so the weighted average lease term. So if you've just got one tenant, then they've got 3 years left on their lease. Their weighted average lease term is 3 years remaining. If, however, you've got multiple tenants, multiple properties, it's obviously an average between them of when their leases expire and what's remaining on it. So ideally, you'd love to have an average weighted lease term of 3 years remaining, because that means from the bank's point of view, you've got at least the next 3 years of guaranteed income.
Can I ask Luke a question as well, actually? Luke, just last year, when, the pandemic came out, there was a lot of talk with the government that the lenders, the major banks, were going to just suspend loan repayments. Did a lot of borrowers take that up? And I'm talking about really commercial, because as you said, in that scenario, they've got rent coming in, but that may or may not have been sustainable. So just interested to see how you guys did it in the commercial space, and what the current status is, whether there's still people that have deferred their repayments.
Yeah, so initially with the loan deferrals, we obviously, because it was seen to be the best practice across every bank and the whole industry, we communicated to every one of our clients that it was available to them. We did see an uptake I would suggest potentially 80% of my clients took it up, just out of fear of not knowing what was going to happen in the market more than anything. And there was no, obviously it was interest capitalized, so it wasn't free money, but it did give them that option to see what sort of was going to happen. So a lot of trading businesses obviously took it up. With regards to the commercial investment space, the premise of it was from the government that if the banks were deferring repayments, that deferral should be passed on to the tenant. So if a tenant was requesting, correct. So we couldn't mandate that in any way, obviously. So it was what we were to do was to recommend to our clients, well, if we're giving this to you, you should be passing it on to your tenants. So in the property investment space, I would suggest maybe 50% of people probably took it up, because a lot of the assets, that we have are, better quality tenants that operated throughout it. So they weren't asking for rent relief, because a lot of the ones that did have rent relief were still having to pay it back at the end of it. So for a lot of them that were still trading through commercial warehouses and factories, those businesses weren't really shut down to a degree. So they didn't request the rent relief.
Yeah. That's interesting.
And to the latter part of your question, no, there's not really many left at all that have still got rent deferrals in place.
Okay, thanks. No, good answer. Very interesting.
Thank you kindly. So while we're talking about the commercial property, I may ask Frank, do we expect the commercial property market to continue to grow?
Yeah, thanks, Vee. We certainly do. I think it's fair to say that over the course of 2021, the property market, or commercial property market, increased about 27% over the past 12 months. And if you ask 10 experts, you'll probably get 10 different opinions when it comes to these types of things in terms of the crystal ball moving forward. Most pundits are suggesting a 5 to 10% increase moving forward over the coming 12 months. So by all accounts, we expect further strength in the market. I think the economic indicators would suggest that unemployment rates are low. The cash rate is down at 0.1%. Interest rates are at all-time lows. Inflation is at a higher level than what would normally be the case in many years. So they're all good indicators to see further growth in the property market. I might just use that as a conduit, V. I know that in the chat room there was a question that was put to me, with entry-level investors not being able to afford to buy childcare centres, what would be a good investment option which would provide decent rental income in the Melbourne market? And it goes on from there. I think to answer that question, I think that's exactly right. Not everybody can afford the $3, $4 or $5 million or more to buy a childcare centre or to get into commercial property. In saying that, there are so many investment REITs, real estate investment trusts that you can invest in today, and many of them have a strong exposure into what I call social infrastructure, being your healthcare, education, and childcare in particular. There are funds like Home Consortium, that are probably the market leader in that space at the moment, where you can buy into that investment and have obviously access into that type of asset class. But all of the other major funds, Charter Hall has a social infrastructure fund for childcare and other, Dexus does as well. So just do your research in terms of the investment REITs in real estate, and it certainly gives you the ability to buy into these. And many of those are based on growth, and many childcare leases have between a 3 to 4% CPI increase each year. So you are going to see capital growth over the life of that investment as well. COVID, and following on from that in terms of people working remotely, the fact is that whilst people have been working from home, have still received subsidies, etc., from government agencies to assist when it comes to the rental side of things, and it hasn't impacted the market at all. If anything, it's got stronger and stronger. Thanks, Vee.
Thank you kindly. While we're talking about the childcare sector, I'd like to introduce Manu Arora and Jiten Patani. They are bankers and BDM from CBA. Thank you for coming on board. And probably we'll have Jiten to talk about the investment sales in childcare centre and lending, the lending criteria around it.
Thanks.
Jiten? Yes.
Thanks, Vee. And like Frank has mentioned before, it was rightly put, that the childcare industry has been, COVID-proof, basically, support from the government. And I think with the flexible, working style for the parents, basically, we have seen a lot of demand in terms of the childcare. Plus, the access was free during the COVID period. It was made free by the government. So we have seen a significant rise in, the demand for the childcare centers, basically. And there is a shortage of, childcare centers, particularly in the southeastern suburbs, provided the flexible environment. And, we have seen a lot of investment come through in the land bank transactions as well, basically, lately. Plus, in terms of, holding on a freehold basis, where we extend, up to 70% on the LVR. Plus, we have done, up to 85% on total development costs as well, basically, in terms of development of the childcare. Again, for the leasehold, we have been extending up to 50% LVR, which was a drop, from the previous, where we were extending up to 60-65% against the leasehold. But during COVID times, that has decreased as well. But based on the overall, strength of the group, we can always, push those boundaries as well, in terms of LVR requirements as well, basically. And plus, credit is on board, and we are open for business in the sense, we are looking at each deal on its own merits, basically. So again, it's based on the strength of, the group and everything. We have even supported, new greenfield childcare centers as well, depending on the location and, what the competition is like in the area. So those are the considerations we have been basing it on, basically.
Thank you kindly. Now, I do have Philip Vouliotis from Liberty BDMs. Thank you kindly for coming on board. Yes, Phil. So would you like to give us a brief in regards to childcare centre? Because I think with Liberty, it is a specialised security. So we'll have a different take on it now.
Hey, thanks, Vee. Thanks for having us here. So we're happy to look at childcare centres as well, but we do class it as a specialised security. So we probably don't really sort of where we bucket our properties are more as around alternative use. So the more vanilla the property, obviously, the better for us. So standard warehouses and things obviously go up to 80%, no problem, in metro style. But childcare centres are considered specialised, so we'll probably look around your 50 to 60% LVR mark is probably where we're looking at. We are probably more sort of around the smaller lens as well, so you probably don't really want to go beyond 3 to 4 mil as a lend with us. The head is always what we look at as well. So the better the head, the more appetite there is for acceptability there. I'll give you an example. We had a childcare centre. It was about 3 million. It was down the Surf Coast. It came in as a proposal just to do it as a lease doc lend. It had a ASX listed company as the tenant, operating a childcare centre. They only wanted 50% LVR on it, and the rent was certainly covering the debt payments on it. So we were happy to accept that one as well. So it is specialised, but still, yeah, around that 50 to 60% marker, and certainly can do your alternative verification is something we can still do. We do have a no income assessment proposition as well on more of a short-term arrangement. That's probably more your bridging. It's probably more like a bridging finance, as in do the no income assessment deal, maybe get your tenant in a bit more long-term, or get some financials together, and then we can refinance you into sort of a more long-term product with us. If you are going to your long-term product with us, like your standard low doc or full doc, it is no assessments, no yearly reviews, or twice yearly reviews. It is a set and forget. So our low doc and full doc can be 30 years straight through, no assessment. So it gives you some flexibility there. So yeah, some alternative options for going in, and more your long-term strategy as well.
Thank you kindly, Phil. Now we may move on to Stevie. Stevie, I think we have a question for you. If I want to buy a commercial property within my self-managed super fund, what do I need to be aware of? Thank you.
Thanks, Vee. Yes, and I guess I'm a little bit different to most of the panelists here, as I'm always going to come at these sorts of transactions from a personal wealth perspective. So, in fact, commercial property is a beautiful property when you do look at your self-managed super fund and wanting to get it in there. With buying, I would probably link to what Luke was saying earlier. There's always legislatively limited borrowing when you buy a property. So the legislation dictates a maximum of 70%. But then the lender might overlay their limitation on that, as Luke was alluding to before, to 60 or 65. So there's that to be aware of. So that's very different to buying property outside of a self-managed super fund. But there is the other aspect of, if you own commercial property personally already, it's actually very easy, or a lot easier, I should say, to transfer it into your self-managed super fund. So it just needs to be unencumbered and owned by you personally, and you can use a combination of let's say in specie contributions, which is a non-cash contribution. So it's using the value of the asset to contribute in. Or it could be a mixture of that plus a sale. So you can actually, at arm's length sale, have a transaction between you and your self-managed super fund for commercial only, not for residential. And yeah, there's other small business CGT concessions. So if you're self-employed, there's a whole other world of things you can utilize. So I've definitely helped people with that transaction because they want to keep their commercial property, whether they're kind of transitioning to retirement or not. But it's a great way to inject extra income into your self-managed super fund above what you can contribute.
Thank you kindly. Now, while we're talking about commercial property, now, Ron, what is the best purchasing structure for commercial property?
Yeah, that's also an interesting question. I think, as Jeff said earlier on, everyone should get individual advice, because it really just depends on their own circumstances. But some of the structures, you could buy it in individual names, although, as we talked about earlier on, individual is very much more for residential rather than commercial. People like using discretionary trusts, so family trusts where you've got a corporate trustee and the beneficiaries might be family members, in which case you can distribute the income in different proportions to the different beneficiaries. We've had situations where more than one, so partners, for example, have bought properties. And in that circumstance, we might have a partnership of trusts. So you might have two families that might have two family trusts, and they come together to buy the property. or you might even have like a unit trust where each individual owner has a discrete share in the land owning trustee. So there's different structures. Each structure also has different tax implications as well, and therefore really needs to be carefully considered. So I think there's not one, there's a variety of different structures. I'm doing a few now with a bit of a mix of all of the above. So really, so have a look at it that way.
Thank you. We may move on now to Jeff for an interesting question. What is the actual median value for just houses in Melbourne at the moment, Jeff?
Yes, been a lot of publicity about medians recently there, Vee. And again, we'll see some data soon for the month of October once the month ends. However, at the current situation is if you look at REIV in Melbourne, their data indicates that the median is sitting at about 1,072,000. So Melbourne's topped the million. CoreLogic data, different data set, their median says it's about 962,000. So it's circa that $1 million in Melbourne at the moment. It's interesting to note that Sydney median is around 1.3 million. So that's the difference between the two capitals at the moment.
Thank you. Now, a question for Frank. What should I invest in?
Well, I think it's fair to say at the moment, both the Melbourne and Sydney markets have continued to grow and increase in value. It's hard to pinpoint a specific asset class to buy into. Obviously, residential that Jeff has referred to has continued to grow across the board. Now, from a commercial perspective, whether you're buying into a commercial or retail asset or a specialised asset like the childcare or service station, they obviously have continued to grow over the period. It just comes down to the level of exposure you want to have in the commercial sector. Residential development is always an area that is strong. If you have the opportunity to buy into a residential development site, whether it's linked subdivision, building a duplex, a triplex, or a group of townhouses. So it's pretty hard to pinpoint an asset class. But in saying that, the industrial property market is probably the strongest it has ever been. And the rates that are being achieved in both Sydney and Melbourne are off the scale, so to speak. And the rates that have been square metre of both industrial land and finished product, the rental levels have increased despite the impact of COVID, whether people have been downsizing or upsizing their businesses. So industrial is a pretty special market right at the moment. And industrial is probably an area that you have a lower level of vacancy than what you may in commercial or retail. But your ability, because with residential, a tenant moves out today, and you'll probably have at least in a couple of days and a tenant moves back in. Don't have the same luxury necessarily with retail or commercial or industrial, although industrial certainly has a quicker turnaround in many cases than what a retail or commercial does. So if I was going to be pinpointing something, I'd say industrial is probably an asset class that should be seriously considered moving forward. Thanks, Vee.
Thank you kindly. Now, I'd like to introduce Michael Bolshaw from Pepper Commercial. Now, Michael, can you give us an overview in regards to commercial lending, low docs or odd docs as options, please? Thank you.
Yes, thanks, Vee. Thanks for inviting me today, and good to hear from all the other panelists and the topic of discussion around commercial lending. So just to introduce myself, Pepper, I'm from Pepper Money. So Pepper, you've probably heard of, they are quite relevant in the home lending space and asset finance, as well as personal loans. A lot of that's done online and mainly through brokers. About 2 years ago, we started up commercial lending. So we've been in that space for a little while, very specialized in, or not very specialized, but mainly looking at deals and finding a home for your small to medium sized enterprises. You know, whether it be a factory, a warehouse, a shop or an office, that sort of thing. We do childcare as well, but only specialised if they are not purpose-built. I know that's been a bit of the flavour of today. But yeah, so as far as, and you've probably heard and come across the different form of documentation. We had a lease doc mentioned earlier by ANZ, and you've got a no doc, a low doc, an alt doc. They all have slightly different meanings. Just one thing I'll say up front is the alt doc and the low doc are pretty much similar. It basically refers to alternative documentation or less than your full doc, which is your 2 years tax returns, financials, notice of assessments and those sorts of things for a full doc client. But if they don't have that, or let's just say that information where we're taking an average of the last 2 years won't stack up and show that they can service the loan that they're going for, we can actually look at their most recent BAS statements to get an understanding of their sales and their expenses, and we can use that figure as their net profit before tax in our servicing calculators. So we've got calculators where we annualize that. We work out on the last 6 months BAS how much they'll be turning over per annum, and we can use those figures. So that's what we call an alt doc. And we have another product which is a near prime, where there's only one income documentation required, which could be 12 months BAS, 12 months bank statements, or an accountant's letter to verify that they can afford the property. So I suppose that's where Pepper comes into play. We're a non-bank lender, and we do credit impaired as well. But having said that, only 50% of our book is, that near prime or credit impaired, as opposed to, the full doc clients that we see as well. And I think a number of reasons for that as well. Similar to Liberty, we are more of a set and forget. There's no annual reviews. We don't stitch our clients up with fixed and floating charges. So we're a little bit more flexible in that sense, and a quicker turnaround. I hope that explains what low doc, alt doc, what that means.
If you have any questions, I'll leave it open to the floor now. If you have any questions for our lenders or for our panelists, please do so. Otherwise, I do have questions, but I think it's time for you guys also to, to ask away. If not, okay, so Stevie, how to build diversification into your self-managed super fund investment strategy when you have a large liquid asset at the core of the portfolio?
Yeah, that's my favorite question, actually, because I feel like a lot of people think financial planners are not pro-property. Like, they seem to have this perception that we only want to recommend managed funds. So I actually am what I would say product agnostic. I really like property. I think it definitely has its place in a portfolio and wealth creation. And when clients love property, I like to work with them on the asset that they prefer. And when, in a self-managed super fund, if we're looking at the total portfolio and there's a sort of a big illiquid asset in there, which is property, I'm still a really firm believer on trying to balance that with other liquid and diversified investments and have a really rock solid investment strategy. So what I try to do is create satellite investments. That's what I call them, is just kind of dotted around across the place in the different asset classes, some bonds, some shares, some infrastructure and other sort of fancier assets, but just to make sure that we've got that diversification covered, and they're not fully exposed just to one asset class in case, God forbid, something happens. But yeah, that's a way of mitigating risk there.
Thank you. And the last question for Ron. Yes.
You're far away.
Can you hear me? Sorry.
Yep.
Yes. What is the status of any COVID rent relief arrangements to consider when buying and selling a commercial property, Ron?
Yeah, so that's. I just wanted to touch on that actually, because Luke raised it when we were talking about deferral of loan payments. Yes. That last year, when sort of the pandemic hit, the National Cabinet, being all of the state premiers and Prime Minister, etc., established some good faith leasing principles where they basically said for small to medium enterprises, if your rent is reduced, if your turnover is reduced directly as a result of the pandemic, the tenants can ask landlords for a reduction in the rent that they're paying under commercial leases. And the ruling, each state brought out their own legislation, but in a snapshot, the rent reduction was commensurate on the tenant's reduction in turnover. Half of that rent was waived, which means the landlord would never get it back, and the other half was then deferred, which meant that the tenant would pay it at a later date. Now, some states have still got the legislation. Victoria reintroduced the legislation a couple of months ago. So as Frank's talking, or a lot of us are talking about buying and selling commercial properties, you might still have this overhang where the tenant actually has still got to pay deferred rent from these early arrangements that I was talking to. And there's no right or wrong reason. At law, the tenant has to pay whoever is the owner of the land. So effectively, if you're a vendor, landlord, you're selling the property, you should try to get an adjustment with your purchaser whereby any deferred rent during the period that you were landlord should be paid to you at the settlement of the property transaction, and then the tenant continues to pay that deferred rent to the new owner who will become the landlord. But it's a private arrangement between the vendor and the purchaser, so there's no hard and fast rule, and it might be that could be a consideration in terms of factoring that into the price as well. But it's just interesting to know that there are these arrangements that are still ongoing. With Victoria, it finished at the end of March and it got reintroduced again at the end of July because we went back into that long lockdown as well. So it's definitely something that needs to be considered when you're buying and selling a commercial property.
Thank you, Ron. Now I'll leave it open to anyone who would like to ask any question to Ron, or even Jeff, or Stevie, or Frank, or even to the lenders. If not, well, I may have a last one for CBA. What are the latest updates regarding lending in regards to the commercial property market? So Jiten or Manu, anyone? Jiten? Is it Jiten or Manu who will answer?
I can talk to that. So just in terms of the commercial side of things, basically, again, like Luke had mentioned before, we have a segmentation in terms of, the properties that we're looking at. Like I said before, in terms of the LVR during COVID times, it was reduced, to 50-55% for retail property. And again, we were aiming to, put 60% on industrial or, any commercial property. But again, lately we have seen a change in appetite, and we are pushing up to 65 and 70% for the right client, basically. So again, the discussion with credit, and your credit is supportive of that. It would be interesting to see in the next couple of months when we have, 3 set of financials, basically FY19, FY20, and FY21, to see how the performances of the business have been in the past. And, we would be factoring in the FY19 performance, plus, we'll be also looking at the FY20 pre-COVID. Again, FY20 was hit during the last quarter of the financial year. So again, if we were to strip that out, analyze the figures based on, performance from July 2019 till March 2020, we'll be considering that as well on an annual basis. FY21, we don't expect, for a lot of businesses have been affected due to COVID. So we would be basically basing our decisions based on the past performances. And yeah, we'll be taking a bit more forward-looking approach as well, so projections will definitely come into play. But like I said, we will definitely have an appetite there in terms of, previous past performances to push the LVRs as well, so.
Thank you, Kani, Jiten. Yes, so anyone else, any questions for our lenders or for our panelists?
Yeah, sorry, I had screaming children in the background, but thank you for answering all the questions before as well, Frank, around the childcare investment. And what my question at the moment is regarding commercial is more about if someone is in a position to have the cash and income, but they haven't really got the serviceability, can you use commercial investment in the returns from, say, an investment fund to increase the serviceability? Whoever wants to answer that.
I'll answer that from ANZ's perspective. No. So the beauty of a lease stock or ring fence transaction is that it works in their favour when they've got a strong lease in place, but you can't have your cake and eat it too. So you can't then need to prop it up from additional income as an outside source. So we're not assessing all their personal position when we're doing a commercial property investment transaction. So then on the flip side, we can't then include that income when it suits them as well. So yeah, if however it's different, if they've got a trading business or something like that, it completely changes the whole application process, and LVRs and policy and all the rest. But for pure commercial property investment, no, the beauty of it is it's ring fenced to the actual transaction.
So is that the same though for just an investment fund? So they're not actually buying property; they're just putting the money into a fund.
Like a syndicate lending, you mean?
Yes, it's more, so some developers have created a fund which, as an investor, I believe they create a discretionary trust for you for your account kind of thing, depending on how much you're investing into that fund. But that fund then finances the development that they're doing.
Yeah, but what we would class as syndicate lending. And then if you're talking, so syndicate lending is very, I guess, detailed, and it's got its own issues that arise with that sort of stuff around, who guarantees it and who's liable for the debt, etc. And then if there's development added on top of that, that's another level of complexity. So very, very specific question. And if you do have a scenario relating to that, we'd just probably introduce you to our property development team because they've obviously got the expertise in that area.
Yeah, that'd be great. So obviously there are some developers I've partnered with, some Australian, some New Zealand. They all have a very similar structure. It's just something very uncommon, and it's hard to advise any clients to even look at it because there's not much information out there. I might probably just touch base with all of you at some stage to get a bit more understanding around it.
I can send you the email for look, and then we can, follow up from there if you like, Ramona. Thank you.
Perfect.
Yes. Anyone else got any more questions?
I was just going to jump in and say, Pepper is more of a KISS lender. We keep it simple. So that scenario sounded a little bit complex for our likings, but having said that, please consider us for other lending needs, and we'll help out where we can. Thank you.
Thanks, Michael.
Thank you.
The other one thing I was going to say is developments. And I know a lot of you probably look at development finance. That's probably one other area that we wouldn't be able to assist with. All your owner-occupied and investment commercial requirements.
Thank you.
Alrighty, I think we're going to hit 9 o'clock. So if you have any questions, shoot away. Anyone? Or
just a quick one, Vee.
Yes.
So if the property is going to be developed, how would it be financed if there's no, if the person can't show serviceability for that particular property?
Any lender would like to answer this question?
Won't get developed is a quick answer.
The one thing, Mina, I know that from a legal perspective, because we do a lot of legal sign-offs with the banks, they look at the pre-sales, a lot of them, to make sure that you've got a certain number of pre-sales and to ensure that they will cover repayment of the loan. So it might be that you've got pre-sales of, say, 100 or 110% of the full loan construction finance. And in those circumstances, the lenders often will agree to provide that. That they rely heavily also on legal the legal representation of the developer, because we actually have to provide a formal legal sign-off to the bank to certify that the contracts are enforceable and comply with all of the off-the-plan development laws and everything as well. So that's one. The other ones are that I've had where they've taken securities, not just the development property. The developers had external other property or other securities that have been provided in order to ensure that there's a repayment of the loan.
I might just jump in just from a Liberty point of view there just quickly. Look, we don't do construction. We don't touch it at all, but we do help a lot of developers. We're happy to assist with the purchase of the property, and if they want to sit on it and get plans and then refinance out later, a few years later, we can do that. We have that no income doc product, so it's just purely based on the asset. So developer income being chunky and can't assist with it, we can lend theoretically up to 60% as no income assessment whatsoever. It's just purely lent against that. And also, just from if you do want to do construction, we won't let you do it on the land. If you have other property, happy to do a straight cash out on other property, and you can fund your construction on that. And that is a no income assessment. We call it the Liberty Boost, just from there. And there is a rate premium for that product and another additional one for developers too. So anyone wants any info on that, yeah, feel free to reach out to.
Fantastic. And anyone else? No? So Ron, I think we've reached 9 o'clock. I think everybody needs to head back to work as well. So I'll let you.
Yeah, I just wanted to really firstly thank all of the guests for coming along. We try and make it very interactive with a bit of discussion. Today has been very engaging in terms of putting in comments, answering questions. So it's really not just for the panellists. We're trying to facilitate a discussion for everyone, and some really interesting questions along the way as well. I also just wanted to thank our fellow panellists as well, Stevie, Jade, Frank and Jeff, and especially Veena for putting it all together and hosting and facilitating and organising everything. We'll hope to have something again when Veena, maybe early in the new year, and maybe in terms of a webinar or a bit of an educational at some stage as well. So be really good to see everyone again. And as a lot of people have said, I think Phil, Michael, Luke, the panellists, if you've got any other questions or if you've got any discussions, just reach out to us directly. We're happy to. I think everyone's really happy. We're trying to network a little bit as well. So I think that's the other beauty about getting together here. Everyone gets to know everyone a little bit with questions and comments and everything also. So with that, Veena, I'll hand back to you to wrap everything up. But thanks everyone again.
Yes, thank you. Now feel free to leave your contact in the chat room. Now I'd like to thank you all, our special panelists, our members, our beautiful audience, and special acknowledgement to all our business development managers, lenders and bankers today to have put in efforts to collaborate constructively for the benefit of all involved. Now, as we all know, education is key and support is evident as we all form part of a big team. So thank you kindly for your efforts, your time today. And if you want any follow-up, feel free to contact anyone on board. And I wish you all the best. Have a beautiful day. Stay safe and stay well. And probably we're going to kickstart the new year, maybe end of January, with the property code. So this is, I think, the last one for the year. So thank you for attending today. Take care and have a
if everyone just enjoy the rest of the year and everyone's freedoms, especially Sydney, Melbourne people, get out there, enjoy a good coffee, network, and hopefully see everyone again very soon.
Thank you and take care.
Thanks, guys. Well done, V. Well done.
Yeah, thanks.
Thank you, Jeff. Thank you, everyone.